Level 1. The model at 2 a.m. You are 23 years old, sitting at a desk on the 14th floor of a building in Midtown Manhattan, and the Excel model in front of you has 47 tabs. It is 2:17 a.m. on a Thursday in September. The associate 2 years above you sent the email at 11:43 p.m. with the subject line, Updated Assumptions. And you have been rebuilding the leveraged buyout model since then. You are calculating whether a $680 million acquisition of an industrial equipment manufacturer can generate a 2.8 times multiple of invested capital over 5 years. The VP who will present this to the partners tomorrow at 9 a.m. will not look at your work until 7:30 a.m., which means you will send it at 6:45 a.m. with enough time to fix whatever is wrong. Your analyst class started with 12 people. You have learned that the model is never about whether the deal works. The model is about showing you can build a machine that produces the answer someone already wants. You adjust the revenue growth assumption in year 3 from 4.2% to 4.8%. The IRR moves from 22.1% to 23.7%. You save the file. Outside the window, you can see lights in other buildings where people are also awake, also building models, also learning that technical competence is the minimum requirement, and that the actual skill is understanding what answer is needed before anyone says it out loud. Level 2. Senior Associate, Learning the Language. You are 26 years old, and you have been promoted to Senior Associate. You make $215,000 per year, plus a bonus that was $180,000 last year. You work on 4 deals simultaneously now, which means you manage 2 analysts who build the models you used to build. The partner leading your deal team is named Garrett Whitmore, and he speaks in a language you are learning to interpret. When he says, let's get creative on the financing structure, he means push the debt-to-EBITDA ratio higher than the banks initially proposed. When he says, help me understand the management team's thinking, he means find out which executives will resist the operational changes we will require and calculate what it costs to replace them. You are in a conference room with the CEO of a company your firm is buying for $340 million. The CEO has built this business over 18 years. He believes the partnership will help him expand into new markets. You have seen the 100-day plan. It involves cutting 23% of the workforce and selling the division he calls his legacy project. You nod as he talks about growth and partnership. You take notes. Later, you will build the model that shows how the equity value increases if you sell that division in month 4 instead of month 9. The CEO's earnest belief in partnership makes the model work better. His excitement about the future is an input that improves your returns. You file this away. Level 3. Vice President, Running the Process. You are 29 years old and you are a vice president now. Your title means you run the deal process, while partners find the deals and make the final decisions. You manage a team of 2 senior associates and 4 analysts. You make $340,000 in salary, and your bonus last year was $420,000. You have learned that deals do not happen because they are good ideas. Deals happen because you create a process that produces momentum. You are managing the acquisition of a healthcare services company. You have contacted 47 potential buyers. You have scheduled 12 management presentations. You have created a data room with 8,400 documents organized into 23 categories. You have written an information memorandum that describes adjusted EBITDA, which is different from EBITDA because it excludes certain expenses that you have classified as non-recurring, even though 3 of them have recurred in each of the past 4 years. This is normal. The company's actual EBITDA is $63 million. The adjusted EBITDA is $81 million. The purchase price would be negotiated as a multiple of the adjusted number. You are creating value by redefining which expenses count. The management team asks you if this is standard practice. You say yes because it is. In the office at 9:30 p.m., you receive an email from a senior associate asking if the adjustment to warranty reserves is aggressive. You reply that it is within market norms. You do not reply that market norms are determined by what buyers accept, and buyers accept what gets presented with enough confidence and comparable precedent. You close your laptop. You have dinner plans tomorrow with someone from business school who now works at a different firm. You will not discuss specific deals, but you will both understand exactly what the other person does and why the adjusted EBITDA matters more than the actual number. Level 4. Principal. Taking carry. You are 33 years old and you have just made principal. This is the level where you begin to receive carried interest, which means you now own a small percentage of the profits from the funds you work on. Your salary is $450,000. Your bonus last year was $620,000. Your carry from 3 funds that have not yet exited their investments is worth either $2.1 million or nothing, depending on whether those deals perform above the hurdle rate. You now sit in the meetings where investment decisions are made, though you do not yet have final voting authority. You have learned that at this level, the skill is not analyzing deals, but originating them. You spend 40% of your time on planes. You have coffee with 11 CEOs per month. You attend 3 industry conferences per quarter. You are building a network of people who will call you before they call anyone else when they are ready to sell. You have identified a manufacturing company in Ohio that is owned by a 68-year-old founder who has no succession plan. You have been having lunch with him every 6 weeks for 14 months. You do not discuss selling his company. You discuss industry trends, regulatory changes, his concerns about tariffs. Last month, he mentioned that his daughter is not interested in the business. You nodded and asked questions about what he thinks the company needs in its next phase. Yesterday, he called and asked if you would be open to a conversation about options. You said yes, of course. You would be happy to explore what might make sense. You have already built the model. The company generates $41 million in EBITDA. At 8.5 times EBITDA, the purchase price is $348 million. With 4.2 times debt and operational improvements you have already identified, the projected IRR is 26.3%. The conversation you are about to have with the founder will feel exploratory and collaborative. The outcome has been calculated for 14 months. Level 5. Managing Director. Deploying capital. You are 38 years old and you are now a managing director. You have been at the firm for 15 years. You make $680,000 in salary. Your bonus last year was $1.4 million. Your carry from exited investments over the past 3 years was $6.2 million after taxes. You have $11.8 million in carry from current funds that will vest over the next 4 to 7 years if the deals perform. You now have voting authority on investment decisions. You sit on the investment committee. You lead deal teams. You have portfolio responsibility for $840 million in deployed capital across 6 companies. One of those companies is failing. You acquired it 28 months ago for $290 million. The thesis was that you could consolidate a fragmented market and improve margins through operational excellence. The market consolidated, but 2 larger competitors moved faster. Margins compressed instead of expanding. The company is worth perhaps $180 million now, which means this deal will lose $110 million of investor capital. You have a decision to make. You can invest another $35 million to fund an acquisition that might stabilize the business, or you can begin a process to sell the company and realize the loss now. You run both scenarios. The additional investment has a 30% chance of producing a recovery that gets you back to break even. It has a 70% chance of losing the additional $35 million on top of the loss you have already incurred. You recommend the sale. In the investment committee meeting, you present the analysis clearly. You explain the original thesis, what changed, what was missed in diligence, what the options are now. The partnership agrees to sell. This will affect your bonus and your reputation, but it will not end your career because you managed the presentation of the failure correctly. You showed judgment, discipline, willingness to face reality. Two of the other managing directors have had worse losses. One of them tried to defend the additional investment too long. He is no longer at the firm. You have learned that the skill at this level is not avoiding losses, but managing how losses are absorbed and distributed. You call the CEO of the failing portfolio company and tell him the firm has decided to explore strategic alternatives. He knows what this means. You schedule a call with the placement agent who will run the sale process. The loss is already being converted into a narrative about prudent risk management and disciplined capital allocation. Level 6, Senior Managing Director, raising the fund. You are 43 years old and you are a Senior Managing Director. You have been at the firm for 20 years. You now lead fundraising conversations with limited partners. The firm is raising its 7th fund. The target is $3.2 billion. You spend 3 months per year in meetings with pension funds, endowments, sovereign wealth funds, and family offices. You present the firm's track record. Fund 4 returned 2.6 times. Fund 5 returned 2.9 times. Fund 6 is 60% deployed and tracking toward 2.4 times. The conversations follow a pattern. The LP asks about your differentiated sourcing strategy. You explain the firm's industry focus and proprietary deal flow. The LP asks about operational value creation. You describe the portfolio support team and margin improvement initiatives. The LP asks about downside protection. You present the loss ratio data and explain the underwriting discipline. No one asks what happens to the 4,800 employees who were laid off across your portfolio to achieve those margin improvements. No one asks about the pension obligations that were restructured, or the supplier contracts that were renegotiated, or the communities where plants were closed. These are not relevant questions in this context. The relevant questions are about risk-adjusted returns, fee structures, and alignment of interests. You answer those questions with precision and data. You are good at this. The fund closes at $3.4 billion, above target. Your carried interest percentage in this fund is 4.2%, which is higher than your percentage in previous funds because you are now senior enough to negotiate points. If this fund performs consistent with prior funds, your carry from this fund alone will be worth $47 million to $63 million over its lifetime. You have successfully raised capital that will be deployed into 18 to 24 companies over the next 4 years. You are thinking about which sectors are misunderstood by the market right now, where inefficiencies exist, which business models can be improved with leverage and operational changes. You see patterns that other people miss. This is the skill that generates returns. Level 7. Partner, owning the strategy. You are 49 years old and you are a partner. There are 8 partners at the firm. Together, you control $11.2 billion in assets under management across 4 active funds. You own 6.8% of the management company itself, which generates $168 million in annual management fees at the current fund size. Your personal compensation last year was $8.4 million in salary, bonus, and distributions. Your carry from existing funds is projected to be worth $38 million over the next 6 years. Your ownership stake in the management company is worth approximately $92 million at the valuation established in the most recent secondary transaction. You sit in meetings where the discussion is no longer about individual deals, but about firm strategy, fund performance relative to benchmarks, LP relationship management, and succession planning. You have stopped working on specific transactions. You review deals that managing directors bring to the investment committee. You vote. You pattern match against the 160 deals you have seen over your career. You know what works and what does not work, and your knowledge is expressed as a yes or no in the final vote. The firm is considering launching a growth equity strategy in addition to the core buyout funds. The discussion is about whether this dilutes the brand or expands the addressable market. You argue that it expands the market because the LP base is different and the return profiles are not correlated. The firm decides to launch the strategy with a target first fund of $600 million. You will not lead this effort, but you will sit on its investment committee. Somewhere below you in the organization, a 24-year-old analyst is building a model at 1 a.m., learning the same things you learned when you were 24. The analyst believes this is about finding good companies and helping them grow. You remember believing that. The analyst will learn, as you learned, that this is about generating returns for LPs by finding mismatches between what assets cost and what they can be made to produce under different ownership and capital structures. The analyst will learn this gradually, through repetition, until it becomes obvious and then invisible. Level 8, Managing Partner, Perpetual Deployment. You are 54 years old, and you are the managing partner. You have been at this firm for 29 years. You oversee $14.7 billion in assets under management. The management company you partly own generates $220 million in annual fees. Your ownership stake is now 11.3% of the management company. Your personal net worth is approximately $340 million, most of it from carried interest that has vested over time and from your ownership stake in the firm itself. You make decisions about firm strategy, partner compensation, LP relationships, and which sectors to deploy capital into over the next 10 years. You sit in conversations with the heads of other private equity firms about industry trends and regulatory risks. You testify occasionally before congressional committees about the economic value that private equity creates. You use phrases like job creation and operational improvement and long-term value. These phrases are not false. They are incomplete. They describe part of what happens, but not the whole structure of what happens or who bears which costs. You know this. You do not say it because the people asking the questions are not actually asking for the complete structural account. They are asking for a defensible public explanation. You provide that. The firm is performing well. Fund 7 is 70% deployed and tracking to a 2.7 times return. Fund 8 just closed at $4.1 billion. You are already thinking about Fund 9. You have a meeting next week with a pension fund that oversees $89 billion in assets. They are considering increasing their allocation to private equity. You will present the case for why your firm should receive a larger share of that allocation. Somewhere in Ohio, a manufacturing company is struggling with succession planning. The founder is 67 years old. In 18 months, someone from your firm will have lunch with him for the first time. The model has not been built yet, but the outcome is already forming. The machine continues. The capital deploys. The returns compound. You have built something that operates independent of any single deal or person. It is a system that converts operational inefficiency into financial returns. And it works because enough people in enough places need those returns to exist. You cannot stop it. You do not want to stop it. The question was never whether to stop. The question is only what to deploy into next. And you already have 4 sectors identified.